Ever since the election, this market's been full of anticipation, specifically that President Trump's pro-business policies will give the economy a major boost. But what if all this political stuff was merely the icing on the cake? What if many of these cyclical industrial companies were already in great shape? What if American heavy industry is doing a lot better than we thought? That may not be true across the board, but I've got to tell you, after some of the numbers we've seen this earnings season, it's certainly true in some individual case. Exhibit A, Illinois Toolworks, ITW, the high-quality maker of specialized industrial equipment. Last April, I told you that Illinois Toolworks is the greatest industrial company you've never heard of. It's an incredibly well-run company with a stock that's been a real juggernaut, steadily working its way higher long-term. Ever since the market-wide bottom nearly 8 years ago, every single pullback at ITW has turned out to be a phenomenal buying opportunity. The darn thing just won't quit. When I recommended the stock again a little less than 10 months ago, it was trading at just under 105. Now it's at 127. Meaning you got yourself a 20% plus gain if you listened. Now, even though Illinois Toolworks spiked higher in the aftermath of the election, like so many other industrials did, the stock actually stalled out in the second half of December, and it spent much of January doing nothing. That is until last week, when Illinois Toolworks exploded higher in anticipation of a fabulous quarter. And then when the company reported on Wednesday, investors were thrilled by the numbers it put up. You might not have noticed since the stock only rallied $1.50 on the news, but that's just because ITW had already spiked up spiked up 3 points before the day it reported. Ordinarily, when a stock runs going into earnings, it tends to get hit with some profit-taking afterwards. Not here. The results from Illinois Toolworks were so strong that the stock just kept on climbing. In fact, I go so far as to say that this was the perfect industrial quarter. And I think you have to view the current weakness with the stock down $1.59 today, courtesy of the market-wide sell-off, as perhaps the beginning of an incredibly enticing buying opportunity, first one that you've been getting. That's why tonight I want to explain what made this quarter so great, how Illinois Toolworks managed to do it, and most importantly, why I think it's going to continue to do it. First, though, let me give you some background. Illinois Toolworks is a diversified player. What a boring name, I know. Serves a host of different end markets across 57 countries. Their products are involved in everything from deep-sea oil rigs to bridges, wind turbines, healthcare, automobiles, construction, aerospace, mobile devices. I could spend this whole segment listing everything they make. They got a great website, by the way. You can see everything, like fasteners, powertrain mechanisms, refueling systems for cars, ovens, refrigerators for restaurants. Do you ever see those Vulcan? I want one of those Vulcans at Bar San Miguel. Diagnostic machines that ensure the safety of airplanes, suspension bridges, welding gear for all sorts of industries, semiconductor test and measurement equipment. While this might seem like a complicated pastiche of disparate products, the truth is that CEO Scott Santi has spent the last 5 years streamlining the company. Back in 2012, Illinois Toolworks decided to change its business model. In the past, the company's growth had been driven by acquisitions. But under Santi's leadership, ITW decided to focus on generating organic growth, the kind you make yourself, much more valuable than buying it. And that's made the company a lot more efficient. Not only that, but Illinois Toolworks got out of 32 different businesses, mostly commoditized products with low margins, in order to focus on their more profitable divisions. Those cast-offs have done nothing. And they've spent years cutting costs to become a leaner, meaner, more competitive industrial. Basically, the company exited some not-so-hot businesses in order to double down on what was working. And boy, oh boy, has that strategy paid off. Illinois Toolworks has been delivering excellent numbers for years now, but this latest quarter the company reported last week, it's the most compelling evidence yet that management strategy is working like a charm, and that we do have the industrial champion of America, ITW. However, you might not notice the greatness of these results at first glance, because the headline numbers are a bit misleading. According to headlines, Illinois Toolworks earned $1.39 per share, 2-cent beat, up 13% year over year. Although when you exclude some one-time items, they actually earned $1.45 per share. Now that's a 17.9% growth rate from an industrial. Meanwhile, the company's revenues came in a tad light, up 3.9% versus last year. What matters to me, though, it had 2% organic growth, which it was at the very top of management's previous forecast. Oh, and the company's self-help initiatives continue to bear fruit. Operating margins came at 21.8%, up 110 basis points. It is very hard in this atmosphere to get that done. On top of that, Illinois Toolworks gave bullish guidance for the next quarter, projecting 1% to 2% organic growth, more margin expansion, and earnings right in the middle of what the analysts were looking for. Given this company's track record of under-promising and over-delivering, I would not be surprised if the guidance turns out to be conservative. As for the full-year forecast, ITW simply reiterated what they said at their analyst day back in December. Again, I think there's good reason to believe that these are lowball numbers, because this forecast doesn't include any kind of uptick in the company's industrial or oil and gas end markets. That means if the economy gets stronger, fairly likely, or we get a big increase in oil drilling, very likely, then the estimates here will once again prove to be too low. How'd they do it? What's the secret sauce here? A lot of this strength comes back to the factors I talked about when I recommended ITW last year. For example, Illinois Toolworks has a philosophy that's become integral to the way the company does business. It's called the 80-20 strategy. This is based on the Pareto principle, the notion that a typical company gets 80% of its sales from 20% of its customers, or 80% of its sales from 20% of its products. Once you figure out who your key customers are, you focus on doing everything you can to sell them more stuff. Once you figure out your key products, you streamline production to make them as profitable as possible. I know, it sounds gimmicky. It sounds like a new age thing. Forget about it. It's real. It's real because the results speak for themselves. At the same time, Illinois Toolworks is very selective about the businesses it gets into. Take the company's welding division, which has actually been one of their weakest ones over the past couple of years because it's levered to the oil and gas space. ITW has built a portfolio of best-in-class welding brands, though, which allows them to offer a kind of standardized one-stop shop for automated welding services. And even during the downturn, the company's welding margin stayed strong. Now, this business could be ready to rebound thanks to the Trump administration's embrace of pipelines. I think the nerves are sore. In short, Illinois Toolworks, the company, is fabulous. What about the stock? Okay, using the midpoint of their guidance, ITW trades at 21 times this year's earnings estimates. Although, again, I think that guidance is probably too conservative. If you look out to 2018, 18 times next year's numbers. In short, even after this remarkable rally, ITW still only trades at a small premium to the S&P 500. That is ludicrous. Here's the bottom line. Even if you didn't listen to me when I recommended ITW 22 points ago, it is not too late for you to buy the stock. Their latest quarter was fantastic. The stock remains relatively inexpensive, and I believe the hungry management team will continue its constant improvement and share take, not for months, not for quarters, but for years to come. It's the ideal stock to buy when the market loses faith in the Trump agenda, but you still want to own an industrial that can put some big points on the board either way. I don't want to jinx him, but if you analogize, Santy's Bill Belichick, and these guys are like the Patriots, perennial champs. They know how to win. Stick with Cramer.